Welcome to part one of the portfolio review for our Discord member, Peachy. Peachy has two accounts, the first of which is a Roth IRA, which we will cover today. It has just under $13,000 in it at the time it was submitted to me. Peachy is 20 years old, student, and small business owner. I have to say, at 20 years old, already having $13,000 in a Roth IRA, that's quite impressive, and that must be a very nice and lucrative small business to give Peachy the ability to do this. The taxable account may be even more impressive, as it has a value of around $40,000 at the time it was submitted to me. But without further ado, we'll dive right in to Peachy's $12,900 IRA. I'm going to make a few assumptions on Peachy's investment style in this Roth IRA. One, there's definitely an income focus based on the high portfolio yield, generating a nice, solid $889 of annual income on $12,900 in portfolio value. Also, Peachy seems like an investor that's not particularly worried about volatility because there is a portfolio beta that's slightly over 1, meaning on average slightly more volatile than the broader market. And also, Peachy lives dangerously, as evidenced by the 19% charge left on the phone. One of the first positions in the portfolio that I think warrants a little bit more attention is Arbor Realty Trust. Arbor Realty Trust is a mortgage REIT. Now, I personally tend to avoid mortgage REITs in general because a lot of them do tend to have a questionable history of dividend cuts as well as a track record of value destruction for shareholders. However, Arbor Realty may actually be an exception to that. One example of that is the growth in shareholders' equity from 2013 to 2022, going from just over $400 million of shareholders' equity in 2013, up to nearly $3 billion in 2022. That's some pretty impressive balance sheet growth. In that same period, they brought their book value per share from $10.68 up to $17.76. The balance sheet isn't the only thing that grew for ABR. They also took their dividend from 50 cents per share in 2013 up to $1.54 by 2022. That's more than triple the dividends. So this company is not just another MREIT, in my opinion. So while I don't personally hold any Arbor Realty Trust like Peachy, I certainly see what the objective was with the stock, and I don't necessarily disagree with it. If I was to buy a mortgage REIT, that's probably the one I would consider. And since this is such a substantial portion of this portfolio, in the 10% range of all the holdings, I thought it was pretty necessary to go over it individually. Now, I'm going to go over the holdings that I personally share with Peachy because in actuality, we actually share a lot of our investment ideas and follow some principles that are similar. So Peachy has ARCC, which I also have. This is a BDC that I think provides a pretty compelling degree of stability and value while producing an approximately 10% yield most of the time. Also, American Express, which I have in my SCHD killer portfolio. The objective of that portfolio is simply to beat SCHD. I don't have a lot of any of the stocks that are in there because it's a 50 stock portfolio, but I do share that position with Peachy. Don't have any of Barings, but we do both share British American Tobacco. I have that in my value portfolio simply to capture the international portion of the tobacco and vaping market. I believe Altria Group provides the best domestic U.S. opportunity, and BTI provides the best international opportunity. Citigroup I hold in the SCHD Killer 50 stock portfolio, and so we both share a small amount of that. as well as CVS Corp, again, in that portfolio. I don't have any Chevron. In fact, I'm honestly overall pretty light on oil and energy. Discover Financial Services, again, it's on my watch list for value, but it is also in my SCHD killer. Eagle Bulk Shipping, I don't have any and haven't really looked into this company, so I can't really speak to it. Primus Financial Corp. Again, this one I don't have any, and I haven't really closely looked into the company. Interpublic Group, again, don't have it. JEPI. So I don't have this, but I've covered it. Honestly, I don't know that it really serves much of a purpose in here. There's already a lot of income producing stocks in here, and I would personally rather allocate into them rather than getting an income ETF like JEPI, but it's not the worst thing in the world. I just think there's probably better use of those funds. Straight up shares of JP Morgan Chase, that is, I believe, in the SCHD killer portfolio, a very small position. LNG, so another energy stock. So again, I'm guessing based on the ticker that this company focuses on liquid natural gas. I'm not really big in the energy sector overall, so yeah, I don't really share that. 3M, I do have in my YouTube portfolio, which is, the portfolio where my viewers actually vote on stocks for me to buy. Yeah, I don't really know why one would get like half a share of 3M. I don't really get it. Why bother at that point? But, it's not the worst pick in the world, but with all the lawsuits and such, not the best necessarily either. MO, that's Altria Group, also share that position. Again, I think it's the best opportunity for domestic tobacco and vaping in the US. Medical Properties Trust. Okay, this is one of my larger positions, actually. I think it has a pretty compelling value proposition. Its tangible book value is around $14 per share, and it's currently trading around $5 per share. My average cost basis is like $9. It looks like Peachy has an average of about $8.83. So like we're in a pretty similar boat on MPW. Nextera Energy Partners LP, I think that's a master limited partnership. I usually stay away from those because, again, it's the energy sector, and aside from yield, I don't really know what else it is that they offer. And the schedules K1 can be a bit of a pain in the butt for tax purposes, but I guess in a tax advantage account that may not make a difference. Don't know New Tech. Realty Income, this is probably the best triple net retail REIT that there is, but I think the cost basis of $62 is a little bit overpriced. I like it much better around the $50 mark, which is close to where it is today. So I'm kind of looking at it. Haven't really made any moves yet. It is in my SCHD killer portfolio, but that's like a fraction of a share that I have in there at this point. So not really much to write home about, but I don't dislike Realty Income, and there is an opportunity to average down and get this cost down to an acceptable level. Blue Owl, I think, is another BDC. I don't own it myself, so I won't comment too much on it. Pfizer in the SCHD killer. It's one of the premier pharmaceutical companies out there. I'm personally a healthcare bull, so that jives with my style quite a bit there. Pennant Park Floating Rate Capital, that may be another mortgage REIT. I'm not too terribly familiar with them. I haven't covered them personally. Again, I don't like to be too heavy into mortgage REITs and things like that, so that's kind of where I'm at with that. Procter & Gamble, I can't remember if I have them in the SCHD killer portfolio or not, but this is a solid consumer staples, kind of stable, boring business. You could do worse than putting something like this in an IRA and just, letting the growth of the world economy and GDP do its thing and add to the bottom line and top line for this company. Qualcomm, this is an interesting company. Now, it's in the SCHD killer portfolio, but it is kind of on my short list to watch out for a more value-orientated opportunity for them. They produce a lot of, I guess you could call it cellular type technology. Believe it or not, they also produce a lot of technology that's used in the trucking industry, things involving like communication with drivers, I think even electronic logs and things of that nature. So it's a pretty interesting business. Definitely an integral part of what we would think of as like the real economy. New Residential Investment Corp, RITM. I've heard of them. I believe they're a REIT and focused on residential property. Don't really have much to say one way or the other. I do think we're maybe in a bit of a residential housing bubble situation. The worm might turn on that depending on what their exposure is. So I don't know how much I like that, but I don't know too much about the specifics of the business to, really give an educated opinion there. Star Bulk Carriers, I believe that's a ocean shipping company. So I think COVID made some things weird in that industry overall, and I'm kind of more interested in seeing what the new normal is before I would consider getting involved there. SCHD, well, I designed a portfolio specifically to crush SCHD, so I wouldn't bother putting my money there if I've already got I think some of these stocks actually are even in SCHD already, and personally, I would just pick the stocks out of SCHD that I like and agree with and put them in my portfolio, especially if I have access to fractional shares. And I would just forget about SCHD, forget about letting Schwab, do the, management and the picking for me. But that's just my opinion on that one. Starwood Property Trust. Again, I'm guessing this is another REIT. Don't know anything about this one in particular, so I'll move on. Trinity Capital. Guessing it's another BDC. It's not one that I've heard of, so can't really get into it. Haven't really heard of 6th Street Specialty Lending either, but I'm guessing a lot of these ones I haven't heard of are either REITs or BDCs. Unilever. Now, this is a consumer staples company. They actually own Ben & Jerry's. I'm a big fan of Ben & Jerry's, so bullish Unilever. They're also in my SCHD Killer portfolio. I'm not too familiar with VF Corp. Peachy, however, is in my SCHD Killer portfolio. It's a gaming properties REIT. Basically, they own casinos and lease them out to the casino operators. And finally, we've got ZIM Integrated Shipping. Now, I think getting into this company was probably a little bit of a blunder, to be honest. But if Peachy got in at the right time, then there might be some possible potential here. Average cost $20. Yeah, that might be a little bit of a blunder, because ZIM is hard to evaluate because they haven't been public for very long. And a large chunk of the time they were public, they had these ridiculously high yields that were obviously going to be temporary because of the pandemic. So that is one that I can almost safely say was probably a blunder to pick up without having more information to go on. But that being said, I'll get into my conclusions shortly. Before I give my final score, if you've made it this far, please consider giving the video a like and subscribing to the channel. It really helps me out. Overall, one thing I like is that Peachy uses the tax advantages of the Roth IRA in order to offset some of the tax disadvantages to BDC and REIT income. At the same time, I would critique the addition of JEPI and SCHD in this portfolio, as I'm not really sure that they serve a real purpose, and I would say it was possibly a blunder to include ZIM in the portfolio. So my final conclusion here is that I would rate this a very solid 7 out of 10. Basically, I think JEPI and SCHD aren't really serving that much of a purpose in this portfolio, and ZIM was potentially a blunder. I could be proven wrong on that at some point, but that's just where I sit right now. But it definitely gets positive points for using the tax advantages of the Roth to take advantage of the high income generated by REITs and BDCs. If anything, I think it could use maybe a little bit more technology with some growth potential in it. Even something like an Intel or a Taiwan Semiconductor that takes advantage of just the increased global modernization that's happening and probably will continue happening for decades. Or even something like an Apple or a Microsoft on a substantial price dip could be okay. But that's really about all I've got on that one. Make sure you leave your comments below with what you would rate this portfolio, and make sure you join the Discord, link in the description, and watch out for part 2 of the Peachy portfolio review, where I review his $40,000 portfolio.